Section 1. Today is October 31st, 2025. Public money is your money. It comes from the taxes you pay. It is used for things we all need, like roads, schools, hospitals. Because this money belongs to everyone, it is very important to show how it is used. Public sector financial reporting is the process of creating clear and honest reports about this money. These reports tell a story about where the money came from, where it went, and what the government owns and owes. This helps everyone understand the financial health of their country, city, town. When financial reports are easy to understand, they build trust. Citizens can see if their leaders are making good decisions with public funds. They can ask questions and hold their government accountable. For public managers, these reports are essential tools. They help managers plan for the future, control costs, and make sure essential services are delivered. Clear reporting helps governments get help from other countries or international organizations. When a government wants a loan for a big project, building a new dam, a railway line, the lenders will look at its financial statements. These statements show if the government can pay back the loan. Good, clear reports based on international standards show that the government is responsible and transparent. This makes it easier to get the funds needed for important projects that can improve the lives of many people. It creates a cycle of trust and support for development. The International Public Sector Accounting Standards, or IPSAS, provide the rules for this important work. These standards are like a common language for public finance. They make sure that financial reports from different places can be compared. For example, you can compare the financial health of one city to another. This helps identify best practices and areas for improvement. By following these rules, public organizations show their commitment to transparency and good governance. This essay will explain 5 of these important standards in simple terms, helping you understand the story behind the numbers. Section 2. IPSAS 1. How to show your financial story. IPSAS 1 is called Presentation of Financial Statements. This standard is the main rule book for how a public organization should present its financial story. Every public entity must prepare a complete set of financial statements at least once a year. These statements must show a true and fair view of the organization's finances. The goal is to make the information useful for a wide range of people, citizens, investors. The standard tells you what information must be included and how it should be laid out so anyone can read and understand it easily. There are 5 key parts of a complete set of financial statements under IPSAS 1. Statement of Financial Position shows what the organization owns and what it owes. Statement of Financial Performance shows income and revenue and spending and expenses over a period. Statement of Changes in Net Assets or Equity. Cash flow statement has its own standard, IPSAS 2. Notes to the financial statements give more detail and explanations. Let's look at Sunnyvale. At year-end, it prepares statements following IPSAS 1. Its Statement of Financial Position lists assets, town hall, police cars, cash in bank, and liabilities, a park loan, money owed to workers. The Statement of Financial Performance shows property tax revenue and salaries as expenses, so citizens can see how their money was managed. This standard helps everyone compare Sunnyvale's performance with another municipality, even in a different region. If both use IPSAS 1, their reports will have a similar structure. This makes it easy to see which one is managing its resources more efficiently. For public managers, the standard provides a clear framework. It ensures they do not forget to report any important information and guides a complete picture for budget and project decisions. Following these rules builds credibility and public confidence. IPSAS 1. Checklist. Does your report include all 5 required components? Statement of Financial Position, Financial Performance, Changes in Net Assets or Equity, Cash flow, Notes. Is the information presented clearly and in the correct format? Do the statements provide a true and fair view of the organization's finances? Are the statements prepared at least once a year? Without this clarity, Managing public resources is like driving without a dashboard. You cannot see your speed or fuel. Section 3, IPSAS 2, Watching the Cash Move. IPSAS 2 is called Cash Flow Statements. This standard is all about tracking the movement of cash, money in bank accounts and in hand. It is the fuel that keeps public services running. A cash flow statement shows where cash came from and how it was spent over a period, a year, or a quarter. An organization can have many assets, but still run out of cash to pay its bills. This statement helps managers predict future cash needs and ensure they always have enough money for daily operations. Cash flows must be grouped into operating, investing, and financing activities. Operating activities are day-to-day service delivery, collecting taxes and paying salaries. Investing activities involve buying or selling long-term assets, land, buildings, equipment. Financing activities include getting loans, paying them back, and receiving repayable grants. Consider a small public health clinic. Cash in, government funding and patient fees. Cash out, salaries, medicines, electricity. Buying an X-ray machine appears under investing activities. A loan to fund it is reported under financing activities and gives a clear picture of cash movements. Section 4, IPSAS 3, Rules, Guesses, and Fixing Mistakes. IPSAS 3 is called Accounting Policies, Changes in Accounting Estimates and Errors. Accounting Policies. Choose policies that are relevant and reliable, and apply them consistently so reports can be compared over time. Changes in accounting estimates. An estimate is a guess when an exact number is not known, like a vehicle's useful life. If new information shows a truck lasts longer, do not change past reports. Apply the change to the current and future years. Do not change the first 3 years' reports. Adjust depreciation for the current year and remaining life. Errors, a miscalculation or missing transaction. Significant past errors must be corrected by retrospective restatement. Fix the year the error occurred. Correcting errors ensures statements are true and reliable. IPSAS 3 Checklist. Are accounting policies described in the notes? When you change an estimate, did you apply it in current and future periods? When you find a significant past error, did you restate prior financial statements? Is the distinction clear between a change in estimate and a correction of an error? This keeps statements current and avoids confusing past performance. Section 5. IPSAS 4, Dealing with Money from Other Countries. IPSAS 4 is called The Effects of Changes in Foreign Exchange Rates. Many public sector organizations deal with money from other countries. A grant in US dollars, equipment in euros, even an overseas office. Foreign currency values change daily compared to your functional currency. Rule: initially record foreign currency transactions using the exchange rate on the transaction date. If your currency is the local shilling and you receive $100, record it in shillings using that day's rate. At period end, remeasure foreign currency cash and loans using the closing exchange rate. Example: a project in pesos receives $50,000 when 1 year charge 60 pesos. Record 3 million pesos. At year end, $20,000 remains and the rate is 62. Report $140,000 in pesos. The difference is an exchange gain or loss, reported in the Statement of Financial Performance. This shows the real impact of currency movements and helps manage related risks. Checklist: do you know your functional currency? Are transactions recorded at the date's rate? Are year-end foreign assets and liabilities remeasured at the closing rate? Are exchange gains or losses correctly reported? Section 6, IPSAS 5, The Cost of Borrowing Money. IPSAS 5 is about borrowing costs. Public organizations borrow for big, long-term projects, bridges, hospitals, power plants. When you borrow money, you pay interest. This interest is a borrowing cost. IPSAS 5 gives a choice: benchmark treatment or an allowed alternative. Benchmark: expense all borrowing costs in the period they occur. The simpler method: Allowed alternative. For a qualifying asset that takes a long time to get ready, add borrowing cost to the asset's cost. Capitalization. Example: a new airport terminal. Capitalized interest becomes part of the asset on the statement of financial position. Imagine a city borrows $10 million to build a bridge over 3 years. Interest is $500,000 per year. Using the allowed alternative, capitalize it. Year 1, add $500,000. After 3 years, $500,000 total capitalized interest. Final recorded cost, $11,500,000. Instead of large interest expense before the bridge is in use, the cost is attached to the asset and then depreciated over its useful life. Choose one policy. Expense all borrowing costs or capitalize for qualifying assets, and apply it consistently to similar projects. Disclose the policy in the notes. Section 7. Your next steps for clearer finances. We have looked at 5 standards that make public finances clear and trustworthy. IPSAS 1 sets the overall layout. IPSAS 2 tracks cash. IPSAS 3 guides accounting rules, changing estimates, and fixing past errors. IPSAS 4 handles foreign currencies. IPSAS 5 accounts for borrowing costs. These are tools for good governance and transparency. They help citizens understand how their money is used and hold leaders accountable. For managers, they provide a framework for making decisions, managing resources, and planning for the future. They create a common language that builds trust between citizens, governments, and international partners. 3 key takeaways. First, clear reporting is essential for a healthy public sector. Second, IPSAS provides a reliable way to tell the financial story. Third, understanding these basics helps everyone ask better questions. One simple action: find the latest annual financial report for your municipality, public hospital, or government agency you care about. Look for the notes at the end. Find the accounting policies, IPSAS 1 and 3, and borrowing costs, IPSAS 5. This connects rules to the real world and helps you understand local financial health.